I'm Yong and I'll present on my investment analysis on Johnson & Johnson using Hawk methodology, recommending it a buy at a target price of $127. J&J is a healthcare holding company engaged in R&D, manufacture and sale of a broad range of products in the healthcare field. Its operations are divided into three segments, with pharma being the biggest, trailed by medical devices and consumer. Each of its segments ranks competitively globally. J&J's economic PE is below that of a sector average, and its value-cost ratio is lower than the sector median, signaling attractive valuation. J&J has been delivering CFROI above cost of capital consistently. However, the spread has decreased during the latter years, signaling fade. Positive asset growth has been in line with wealth creation principles, and is notable on how the lower than historical 20-year average asset growth for the past 5 years came in tandem with the narrowing of CFROI discount rate spread. Consequently, TSR relative to S&P 500 have become relatively stagnant at a lower level in the concurrent period. We will value J&J using the 3-driver flex model and observe how the projected CFROI differ from that of the default case. Historically, there is a repeated pattern of margins improvement driven by product lifecycle nature, with J&J progressing on its emerging autoimmune pipeline, allowing for temporary ability to attach premium pricing given product novelty, its potential entry into rare diseases markets, providing pricing protection given marketing exclusivity, and its continued remediation efforts under consumer. We expect margins to improve at 1.5% year-on-year from 2015 to 2020. On sales growth, it's been modest due to competition and higher purchasing selectivity by patients, driving pricing pressure. However, given J&J's expansion of key brand presence in emerging markets, its potential entry into the high-growth immuno-oncology market by leveraging on its strong cash position and its portfolio reorientation towards growth, sales growth will be enhanced in the long run. We expect sales contraction in 2015 due to strong generic and biosimilar competitions. Competition and pricing pressures will continue to suppress sales in the short run. Declining asset turns halted in 2012 as low-earning cash balances were used for Synthes acquisition but deteriorated afterwards due to weak sales. We take note of the continual increase in R&D expense to support new product launches, the reduction of net working capital due to increasing liabilities, and the decrease of cash balances to finance inorganic investments when projecting asset turns. We expect gradual improvement in the long term driven by greater commercialization of investments. With our 10-year projected data input, a warranted price of $127 is generated, yielding 23% upside. This seems more accurate than the 33% upside predicted by the default model, as a positive 42% bias indicates that it consistently overtracks its actual price. Our 3-driver model gives a higher than market implied forecasted CFROI, reflecting that J&J will begin escaping from fade at a gradual pace pretty quickly. Despite promising drivers, whether the warranted price will materialize depends on how J&J manage various external environment and internal risks.